Because the exam is very close, I want to do a quick recap on economic value added. The few things you just need to know. But before we move forward, one of the major ways of appraising the performance of a division, like we've mentioned before, is residual income. Residual income method, which says profits minus your imputed cost. And we also mentioned that your imputed cost is your capital employed. So the cost of the capital is always cost of capital is always in percentage. What is the percentage? Multiply that's like the interest. You deduct the interest on the capital you took from profit. You get what you call your residual income. So I'm just taking you from what you already know to what you know. So EVA also apply in this form. Your economic value added also apply in this form. This time around, instead of profit, what you have here is your what we call no part. That is net operating profit after tax minus your this same cost of capital, which is your capital employed, multiply this time around, instead of the cost of capital, to become the weighted average cost of capital, because we believe that this cost of capital, your capital has various sources, so you need to calculate the weight of all of them. So we have to merge all the various capital involved, not just one kind of capital. You could have debt, you could also have equity. So there is need for you to find the weighted average of the cost of capital. So if you see, you can see that they have similarity, like for like. Profit now replaced by net operating profit after tax. So I will going to give a more comprehensive note on this, but just for the sake of this exam, just a quick recap on it. So when you want to start, they will give you income statement. So all you need to do is start by adjusting from the point of the profit after tax. So the income statement will be given to you, but you need to now look out for your profit after tax. So all your adjustments will be done on that. This economic value added is also known as your economic profit. It is similar to your free cash flow. So there is need for you to make adjustment on your accounting profit. So they will give you your accounting profit. You need to make adjustment in order to arrive at this economic profit, which we call net operating profit after tax. So the adjustments you need to make. Adjustments that needs to be made. One, you need to make adjustment on interest costs. Your interest costs, you check the P&L, you see an interest cost. So what you need to do is to add back this interest cost, because before arriving at that profit after tax, interest cost would have been already deducted. So we are saying add it back. We'll come to nitty-gritties of all this. So just add back the interest cost. That's one adjustment you need to make. Add back the interest cost. But now it has to be add back interest cost less tax relief. Add back interest cost less tax relief. So what this means is that for you to calculate net operating profit after tax, it is by saying what is your start. Like I said, start with the profit after tax in the income statement. You add less the interest cost. whatever is the interest cost in income statement. Like I said, is interest cost less tax relief. So you deduct, because before arriving at the profit, you've already deducted its interest rate, and profit has been, and tax has been applied. So you less the, so we say interest cost less tax relief minus your tax, whatever is the percentage. So if this is, for instance, if the interest cost is 10,000, you now say, what if tax rate is 30%? You now apply the 30% on 10,000, which is 3,000. You now deduct the 3,000 from the 10,000. So what you have, so for instance, you have 10,000 here minus tax interest on it, which is the tax relief, which is what is also we be giving there. What is it? Let's say it's 30%. 30% of 10,000 is 3,000 minus that. So what you finally deduct will be 7,000. So first adjustment you do your interest adjustment. So net operating profit. Let me clean up this so that we don't. So net operating profit after tax is equal to profit after tax minus interest cost. Interest cost less tax relief, which is the tax percentage. So I put this in brackets. So this is the calculation. So the next adjustment you need to do is on depreciation. Depreciation. Depreciation, you add back because it has been deducted before arriving at the profit after tax. So for your depreciation, you should add it back. So what it means is that it will be something like this. So for depreciation, just to let us know, also for depreciation, we add back depreciation that have been deducted and deduct economic depreciation. So whereby the value of depreciation is 1,000 and economic depreciation is 1,000. So you have to deduct 1,000 and add back 1,000. So by the time you do that, it cancels out. So I'm just saying, you find out that the economic depreciation and the normal depreciation are the same. So we have depreciation. So what it's add back depreciation. And like I said, add back depreciation and rather deduct economic depreciation. So that will be NOP to calculate. I'm just writing as if I want to calculate now economic profit after tax. It will be profit after tax. Like I said, start with your profit after tax minus your minus your interest cost, or what you call it's like after you minus your interest cost, you can still call it post tax interest cost. So I'm just saying what I've done already in interest cost. So what I've just done, profit after tax minus interest cost, then you profit after tax plus, rather, not minus, please remember we are adding back the interest cost. Post tax interest cost, add back, then also add back depreciation. Like I said, if there's economic depreciation, so this is like saying accounting depreciation. Then you now add back, deduct accounting depreciation. I mean economic depreciation, sorry. So you have profit after tax. After you, so let's say we are doing everything all over. You take your to calculate not your to calculate your NOPAT, which is your net operating profit after tax. You start with your profit after tax, add back your interest costs, less tax relief, then add back also depreciation. So, but if there is economic depreciation, you'll not deduct economic depreciation, whereby they are the same. It basically gives you a zero impact. So number 3 adjustment is other non-cash expenses. We said other non-cash expenses because normally depreciation should have been part of this. So we are saying normally all non-cash items, because depreciation has a different treatment. So that's why I will have to spell out depreciation differently. Then we'll now have the other non-cash expenses. So for the other non-cash expenses, they should also be added back. A good example of non-cash expense is provisions and allowances. So we say add it back also. So it's like if I want to calculate my net operating profit after tax, I start with what is my profit after tax minus interest, add back interest costs, less tax relief, add depreciation, then because all these things would have already been deducted before arriving at profit after tax, so we are saying add back depreciation, add back we now rather deduct economic profits, depreciation, economic depreciation, and now add also non-cash item, not cash expenses. Like I said, we have provisions, they are non-cash. We have allowances, we have other like impairments, losses, and the rest. As far as they are non-cash, unrealized profits or unrealized losses. Unrealized losses should have been deducted, say add it back. But if it's profit, it's the other way. Unrealized profit, you deduct, because you would have been added to arrive at profit after tax. But if it's unrealized loss, you add back, because we are saying unrealized loss would have been deducted for arriving at profit after tax, and maybe deferred tax expenses. So provisions and allowances, basically they will not. I know the exam has not usually expand to this much, to more than much of this, but so just know that anyway, any other non-cash item you see on the, like we said, we have provisions, you have allowances, you have impairments, you have impairment loss or realized losses. All those stuff have been deducted. So these are basically. Then we also have, finally, I think there's one more. We have also number 4. Number 4, which is the final one, is the investment in intangibles. Investment in intangibles. Intangible, e.g., research and development. Research and development, add back. So research all these investments on intangibles, like advert is an intangible. Advert, which is based on management discretion. Promotions, so it should be added back. So that is basically what you need to do. So all these research and development and the rest, it should be added back if already deducted before arriving at profit after tax. I said also research and development. So these are the adjustments you just need to do in order to arrive to calculate your net operating profits. These are things you need to just add back, and that's all. Therefore, so if I'm just looking at the calculation of, we've looked at this one. Let me use a different pen color. So the next thing is capital employed. So we have this question before us. We have other ones, so I can punch. So, okay, well, let's look at this one. Let's look at this question. So all of them is almost similar. So I can also drop the question, attach the question. So if you look at this question, you are given, this is Owerri Distribution Limited income statement. This is a financial statement. Financial position for the year just ended, year 2. So there is a 1. So now this is year 2. So we'll just look at how we compute. The major thing, like I said, is to compute the net operating profit after tax first. Just like we say, we have profit minus cost of. That's just everything about economic value added. Just your profits minus your cost of capital employed. That's just what it is all about. The issue now is this profit you want to calculate. How do you calculate it? First of all, like I said, you first of all do your adjustment on the profit. Convert the accounting profit to economic profit. So the normal profit you have, convert it. So, and I said for this case, you should start with your profit after tax. Here the profit after tax is 54. So we'll just solve the question and see how it works. So you can always refer back to this. So let's look at the profit after tax. So we start with the solution. Computation of the parts profit, net operating profit after tax. That's the first thing we will compute. Computation of no parts. I said for you to compute it, you need to start with your profit after tax. And our profit after tax in the question is 54,000. Well, it's in millions, so this is equivalent to 54 million. And like I said, what are the adjustments? There are about 4 adjustments. Interest, you add back your interest, add back depreciation, add back non-cash items. That's what we mentioned. And add back also other non-cash expenses and investment in intangibles if they were actually deducted. So interest, let's add back interest. Add interest interest costs. So the interest cost, like I said, pardon me to adjust this to put it shifty further away so that I have some space. $54,000. So interest after cost, that should be, the interest is 8,000. From the question, I remove less the tax effect of 25% minus 25% tax. If we calculate that 25% on this, if we remove the 25%, what will be left is 6,000. Also, we said add back depreciation. But if you check in the question, we are told depreciation is equivalent to economic depreciation. That's the accounting depreciation is equivalent to economic depreciation. I will do another note, but the economic depreciation actually is what is the actual market value of that. Unlike the conventional depreciation, as you buy the asset, depreciate it over a period of time. But economic depreciation, you will need to calculate what will be the economic value of this asset as at present. So an asset that was bought last year for 10,000 and today the value can be 9,000. It means economic depreciation is 1,000 because that's the value you can resell that asset. So economic depreciation is different from accounting depreciation, whereby you just stay as you buy the asset, irrespective of whatever the value costs, you just depreciate it using whatever method. So add back economic depreciation. Since that economic depreciation and the accounting depreciation are the same according to the question, it means they have a zero impact. So the other thing we'll treat is a non-cash item. In the adjustment, you'll see a non-cash item. In additional information, you see a non-cash item expense of 16,000. So if I add back and I'm done, you have gotten your net profit after tax of 76,000. The next will be to calculate our capital employed. Like I said, capital employed, computation of capital employed. Capital employed, from the book we are told, remember we said book value. So what we have here, book value of total assets. So capital employed can be calculated in various ways. So we have different ways, actual approaches to calculate capital employed. Your capital employed could be your assets, your total assets. That is your non-current asset plus your current asset added together, less your current liabilities. That's another way to calculate it. Or your total capital employed in terms of what is the value of the equity and the value of the debt. So, but in this question now, we can look at it from the point of view of the book value of total assets less current liability, which is book value of total assets. We are given the question. You can see in the additional information. Less current liability. Is 435,000. There was we said there are 3 adjustments you can do on capital employed. So we said you look at investment in intangible, add it back, provisions and allowances, you add it back, and any off-balance sheet. But in this case, in this question, we're only giving that there is off-balance sheet assets which was not capitalized, a non-capitalized lease. Of 18,000. Also in the additional information. So if I add it, I have my 453,000. So we are almost done. So the last one is to calculate. The 3 items are done. We've calculated NOPAT, which is your net operating profit after tax. We've calculated our capital employed. The next thing is to calculate the weighted average cost of capital. Your weighted average cost of capital, from this question, we are told that cost of equity is 12%. And what is the weight? The company said they were going to share the weight by 50. If you take the adjustment, it has to be 50-50. That 50% of their capital employed should be equity, 50% should be debt. So, like I said, formula says cost of equity times the weight of equity. What's the weight of equity? 50%. Plus cost of debt. The cost of debt is 8%. It's also in the question. Like I said, you have to remove the post-tax effect, which is 1 minus tax rate is 0.25. Then you multiply by the weight. What is now the weight of debt is 50% also. And if we calculate this, total should give us 9%. So we are done. So you can now apply economic value added is equal to, like we said, is your net operating profit after tax minus capital employed multiplied by cost of capital, or weighted average cost of capital, which this we've calculated as 76,000 minus 453,000 multiplied by 9%. So that is just what it is. That should give us a value of 35,230. Just to mention again, this cost of capital, please. Sorry, not cost of capital now. The capital employed. I tried to mention something that the capital employed can actually be measured in different ways. This capital employed. We have various approaches to the capital employed. So on those various approaches, that's what I just want to mention, so that in case, depending on how the question is framed, you can actually adjust, you can actually calculate your capital employed. So we have the operating approach, which is capital employed can be calculated as your total assets, which I've mentioned before. What is your total assets minus current liability? This is what we call the operating approach. Your current total assets is made up of current assets Current, non-current asset and current assets. Remember, your total asset is made up of current and non-current added together. Then you now less your current liability. The other one is what is your equity. You can also look at it from this point of view. Equity plus your debt, long-term debt now. This is the financing approach. Or you can look at it from the net operating asset. Net operating assets. In net operating asset, you are just looking at operating asset minus operating liability. So anyone you're looking at is fine. So once you can achieve any of this one, the first two you usually very prominently use. So once you can achieve any of this one, then you can now adjust. If you calculate now, then you can now adjust for. You can now do the adjustment for either the off-balance sheet item that is not inside the balance sheet. You add it back into whatever you've calculated in any of these three. If you are using any of the method, add back if they mention there's any off-balance sheet item that is not in the balance sheet, or like I said, which is like operating lease, then you can also any investment in intangible assets should be added back. So these are basically the way to adjust. So if you have any question, you can still ask your question